Are you tired of the constant ups and downs of individual stocks? Want to grow your wealth with less stress? Today we're diving into the world of index funds, an investment strategy that's not just simple, but also incredibly powerful. Stay with us as we explain why investing in index funds is often considered a safe bet and how you can make it work for you. What are index funds? An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a financial market index like the S&P 500 in the US, the FTSE 100 in the UK, or the S&P/TSX Composite Index in Canada. Instead of trying to beat the market, index funds aim to match it. Key characteristics of index funds: diversification. One fund gives you exposure to hundreds or even thousands of stocks. Low fees. Since they're passively managed, index funds typically charge much lower fees compared to actively managed funds. Ease of use. They're beginner-friendly and don't require you to pick individual stocks or time the market. If you buy an S&P 500 index fund, you're essentially investing in the 500 largest publicly traded companies in the United States, from tech giants like Apple and Microsoft to consumer staples like Coca-Cola. Why are index funds a safe bet? Now, let's address the million-dollar question. Why are index funds considered safe? It boils down to several key reasons. Historically, markets tend to rise over the long term. For example, the S&P 500 has delivered an average annual return of around 10% since its inception, even factoring in market crashes. Investing in an index fund spreads your money across many companies, sectors, and industries. If one company or sector underperforms, others can balance it out. In 2020, Tesla joined the S&P 500, causing a spike in the index fund's value. Imagine owning a piece of Tesla without buying its stock directly. High fees eat into your returns. Index funds, with expense ratios as low as 0.03% in some cases, ensure that more of your money stays invested. Compare a $10,000 investment over 30 years in an index fund with a 0.03% fee versus an actively managed fund with a 1% fee. The difference: tens of thousands of dollars in returns. Studies show that 80 to 90% of actively managed funds fail to outperform their benchmark index over the long term. Why pay more for worse performance? How to start investing in index funds. Getting started with index funds is easier than you might think. Here's a step-by-step guide. Step 1. Choose your index first. Decide which index you want to track. Here are some popular options based on your location: USA, S&P 500, NASDAQ 100, or Total Stock Market Index, UK FTSE 100 or FTSE All Share Index, Canada S&P/TSX Composite Index. Step 2. Pick a fund. Look for well-known funds with low fees and strong reputations. Examples include Vanguard 500 Index Fund, USA, iShares Core FTSE 100 ETF, UK BMO S&P/TSX Capped Composite Index ETF, Canada. Step 3. Open an investment account. You'll need a brokerage account like Fidelity, Vanguard, or Robinhood in the US, Hargreaves Lansdown in the UK, or Wealthsimple in Canada. Step 4. Automate your investments. Set up automatic contributions to dollar cost average, which spreads your investment over time and reduces the impact of market volatility. Now, let's take a quick break to explore some fun and surprising facts about index funds. They were a controversial idea when Jack Bogle, the founder of Vanguard, launched the first index fund in 1976. Critics called it un-American. Today, Vanguard manages over $8 trillion in assets. Warren Buffett's advice. Even the Oracle of Omaha recommends index funds. He famously bet $1 million that an S&P 500 index fund would outperform hedge funds over a decade. And he won. Trillions invested globally. As of 2024, global assets in index funds exceed $15 trillion. That's more than the GDP of most countries. Pros and cons of index funds. Like any investment, index funds have their pros and cons. Here's a quick breakdown. Pros: low fees. Minimal expense ratios maximize your returns. Simplicity: easy for beginners to understand and manage. Diversification: reduces risk by spreading your money across multiple assets. Passive income: requires minimal effort once set up. Cons: lack of flexibility. You can't customize the portfolio. Market risk: if the entire market declines, so does the fund. Limited upside. won't outperform the market like some individual stocks might. Think of index funds as a slow and steady turtle in a race. You won't get flashy returns, but you're likely to cross the finish line ahead of most competitors. Now let's bust some myths about index funds. Myth 1, they're only for beginners. Truth, even seasoned investors use index funds to build wealth. Myth 2, index funds don't lose money. Truth, they're not risk-free. Market downturns can affect them, but long-term growth typically offsets losses. Myth 3, you need a lot of money to start. Truth, many funds have no minimum investment or allow you to start with as little as $100. Index funds are a simple, low-cost, and effective way to grow your wealth over time. They offer diversification, minimal fees, and proven long-term performance. Whether you're a newbie or a seasoned investor, they deserve a spot in your portfolio. Did this video inspire you to start investing in index funds? Hit the like button, subscribe for more financial tips, and let us know in the comments. What's your favorite index fund and why? Thanks for watching, and see you in the next video.